Right, GM. You should be hearing me right now. All right, you should be hearing me right now. Right now. All right, GM. Can you hear me right now? You should be hearing me right now. Let me know. Let me know if you can hear me. All right. All right, good. So can we all hear me right now? Fantastic. I didn't know what's wrong with the first one, but it is impossible to walk things through and not have hiccups. Challenges are bound to happen. We won't back down, definitely. All right, so we are swinging into action without wasting much of our time, focusing tonight on Forex terminologies. There are terms you hear that you don't know what it means. So let's talk about it today in the Forex market. So I'll be pinpointing them, I'll be explaining, and we'll go swiftly like that. So you should be seeing my screen right now where I have base and quote currency. Is that correct? So I'll be explaining. You can do the reading. I'll be explaining majorly. Please let me be sure of that. You can see my screen, right? Based on quote currencies. All right. So this is one of the first thing I want to explain. Now, if you remember when we were defining forex, I told you it is the simultaneous buying and selling of currencies. All right. When you go to the bureau de change, I told you, you tell the bureau de change, okay, I have a dollar, I want to swap it to naira. It means you give the person dollar, you sell it in that instance. You collect naira means you are buying naira. That is what it means in transaction terms, in swapping terms. Do you get it? That's what we mean by simultaneous buying and selling. Now, this transaction, one of the currency is usually called the base and the second is usually called the quote, and this is how to get it. The first currency in that pair, like I have it here, you can see euro USD. What we trade are usually in pairs. When they say something in pairs, it means it is two together, one and two. When they pair together, you see 1/2. All right. So the base is called what? The first currency on any pair is called the base. In this instance, we have euro USD. Euro in this instance is called the base, and USD is called the quote. Now, what does this mean? Remember, we said simultaneous. Simultaneous means when something is running at the same time, two things are happening at the same time. So it means if you click buy on your chart on after you've done your analysis, now you now click buy, you buy. It means you buy this euro to sell USD at the same time. Just use the borrow the change example that I just did now. When you say you have USD but you need naira, it means you give what you have to take. Swap that give and take for buying and selling. It's as simple as that. So when you give means you sell. When you take means you buy. Do you get it? So when you click buy on euro USD, it simply means you buy euro to sell USD. Now take that scenario of when you transact your dollar to naira from that bureau de change. As we don't say give and take, we just say you give. We automatically know that for you to give the bureau de change your $100, you will definitely take something back, which is naira. So instead of now saying give and take, we just say, okay, I gave him $100. Then I already know you do what you receive 150K. So that is what we are doing here. And the first currency in that scenario is called what? The base. And the second is called the quote. Don't forget. All right, on to the next, which is Forex broker, is that the same thing you're saying right now? Forex broker. So I talked about broker yesterday. They are the firm that provide traders access to trading platform where buying and selling happens. All right. So you have where you do your buying and selling. You have where you do your buying and selling. One of the areas you use for that is given to you by your broker. They are the one that allow you that. And one of it is where for you to trade, you need to open an account with a broker first. The account you open with that broker will is now they will give you a login. The login is what you will now use to log in on your MT5 that I highlighted yesterday when I was talking about where we trade. You log in it on your MT5 or MT4 depending on what you trade, or probably C trader. Now, when you get your account logged in, you fund, then you begin trading. Before you trade, you do your analysis where on trading view. Don't forget, I'm just doing a quick recap. Now, what does this broker, part of what they do, or why we are talking about them again, is that I now said it that if a broker has a wide spread, which we'll still talk about, which is the difference between the bid and ask price, we'll talk about spread specifically after this. Now, there's a high tendency that profit margin available. When I get to spread, I will explain it. Also, let me also state it that as you explore the world of Forex, I therefore choose a broker that gives you minimum. One of the things you want to consider whenever you are choosing your broker is spread. Is their spread too wide or very small? Now, using the scenario of the borrow the change that I mean, borrow the change because it is quite relatable to most of us. You if you've never done it personally, you would have seen people that have done it, or probably our parents might have done it before. That's why I'm using the experience of the bureau de change. Now, when you go and meet a bureau de change, that okay, what is rate? It will ask you, are you buying or are you selling? Because there is different rate for buying and there is different rate for selling. If there's any of us here that trades crypto P2P, you understand what I'm saying by rate. There's a rate you buy, there's a rate you sell. The difference of these two rates is the profit the buyer takes. You that even if you don't trade crypto, you are a marketer, you trade something. You bought something for, let's say you bought it for 10 naira, you sell it for 12 naira. The 2 naira that is on top is your what? Your profit. So profit in that instance is what we are calling the broker commission that they charge you. So imagine when they now charge you too much from what you are trading, that will be exorbitant and it will affect the profit you are making. Imagine you are making $100 from your broker as your profit, but the broker is already taking $10. That's too much. Or they are already happens. Very well, it happens. So you don't assume like how is that possible? It happens. So you want to make sure you choose the right broker. And the link to the broker we recommend will be dropped in the group after this session. I don't want to make people confused, so I won't be sending it right now. Let's just focus. After that, you will get it. You don't really need it right now, so keep calm. Keep calm. Keep calm. So the next we are talking about is spread. Spread. I'm sure you can see that right now. What is spread? Like I said before, spread is the difference between the bid price and the ask price. The bid price and the ask price. Now, what is the bid price? Bid price is simply the price the buyers are willing to buy. The price the buyers are willing to buy is the bid price, and ask price is the price the sellers are willing to sell. That's the ask price. And the difference of these two prices is the spread, and that's the commission your broker take from you. Now, dollar right now, let's say it is trading for 1.4. You buy dollar at 1.4, but when you want to, that's the buying price, that's the bid price. When you now want to sell it, you now sell it to someone 1.450. That's the ask price. All right. So the 1.450 minus 1.4, that's 15 naira. The 15 naira on top is what is the spread. You in that transaction, you are the broker. Do you understand now? You are the broker, and that's 15 naira is what your profit. Do you understand it? So that's how broker works. That's what the broker keeps for taking the risks and facilitating the trade. That's the commission we pay them. You might be wondering, how does this transaction we make, how does it benefit broker? Of course, nobody does anything for free. So that's one of the ways they make their own. Like a spread varies from one broker to the other. There are lots of brokers, XNES, HFM, and if you're a total newbie, you want to pay attention to those that are already in the game to guide you so you don't make mistakes. There are some your own interest. It is in your interest to now pay attention so you don't make the same mistakes again. I have a saying that afogbo ologbon shogbon ni won pe lologbon. When you learn from other people's lesson, that's when they call you a sensible human being. So it is not until you learn that same thing in the hard way. You can simply learn from those that are experienced in it. So don't use any broker that charge too much spread. It is no There's no hype in it. Now, to minimize the spread incurred from broker, trade during most favorable hour when there are more market participants. Competition for this business increases, and market maker often lower the spread to capture it. Also, avoid buying or selling low traded pairs. You could remember yesterday when I was talking about market session, I told you that there are some sessions that when you trade during that time, market move faster. During that time is when they were talking about here. Remember the scenario of when I was talking about the market day and how market moves during that day. You will notice that during those market day, the price of commodity, the price of products, even in our physical market here, you will notice that it usually reduce compared to the actual price on a normal day. Have you ever experienced that? You'd have noticed that it's usually reduced. The same products, and if you go on another day, it will be expensive. That's what they are talking about here. So if you trade the currency at the session that they are active, that there is more participants in the market, then the spread will what? It will reduce. It is like saying you want to sell something for someone at a let's say 1450, but then they want to buy like 100 pieces. You can just reduce it to 1440 or 1430. That way your spread reduces. But then you know that for the 14 naira on top times 100, cumulatively, it will amount to something. So that's why they said it is advisable you only stay in the market when there is more participants in the market. And when there is more participants, it means there is competition. If you don't trade with this one, you can trade with another one. And they want you to trade with them. So they will give you a good price to buy. All right. And also you trade during when there is at the right session. That's avoid buying or selling low traded pair. When you are not supposed to trade, you can't come to the market now. You start trading CHF, JP. There are some pairs that are very slow. Leave them alone. There's no I Go for the ones that move very well, that has volatility. Volatility means that they move very well and they don't just they are not sluggish. Yeah. So the next we are talking about is what is pips. Can you see that right now? What is pips? Now, which stands for point in percentage, is what we call points. And how do we what do we use these pips for? It is used to calculate your profit or loss. It is a standard unit and the smallest amount by which a currency quote can change. What does that mean? Remember currency quotes, base and quotes, all right? Don't forget anything I mentioned, please. Pay attention. Now, pips is how we calculate your profit or loss. Take it as an example from this. You remember your currency now, the naira currency that we have, or any currency in your country. You can see that they have denomination, right? They have price on it, but the price we are coming back there. But these prices now, they used to have. Let's say you owed a bill. There is a number of notes that you expect to be in that bill. Those notes, each note is what we call pips here. So if you're counting, let's say 500 naira, one bill, that's what there will be 50 in it. All right, there will be 50 in it. So you already know what it will amount to. If it is a full one, there will be 100 in it. You know what it will amount to. So pips in this instance is the how to count your profit or loss. Each of those notes is what we call pips. Another example, let's do it this way. The way if you want to measure how long something is, that you measure it in centimeter. The length of something in centimeter, or probably when it is an aquatic volume, you can call it in volumetric cube, or probably you can also use your foot. Say this thing is long 10 feet, it is long 10 feet, 16 feet, just to know how long that thing is. Do you understand? Same thing as it here. So if market should move from point A to point B, how you would know the distance it has covered? It is by knowing how many pips it has covered. Do you grab? So it means the distance from point A to point B can be 10 pips, can be 12 pips, can be 11 pips, can be 1 pips, can be 100 pips, can be 1000 pips, and it goes like that. Can be 50 something pips, anything. And there's a way to count that, which is what we'll be stepping into tomorrow when we enter market structure. All right, don't rush. And I'll give you a tip for USD related currency like Euro USD, GBP USD, USD JPY, Euro USD, GBP USD, USD card. They are always at 0.001. All right, they're always at 0.001. And you see the example that I use here in this instance. We have the price to be 1.099. That is, they have 4 decimal points. That is why it is counted 0.001. But for JPY related pair, those ones are in 2 decimal points. It means instead of 1.009, you will start seeing prices like 1.09, 1.09, 1.02, 1.0, and in that instance, you count it as what? In 2 decimal places. So do you get that? And looking at the screenshot I have here, you can also get to see the bid price I explained before, the ask price, and the pips. So the difference of these two, now, if price should move from 1.0992 to 1.0994, the difference of that two is what? 2 pips. 2 pips. And that's how you know the distance from a price to another. Now let's use Naira. Let's use Naira. The Naira is currently at, let's say it is at 1,450. If it should move to 1,455, it means it has moved what? 5 pips. Do you not get it? It means it has moved 5 pips. And that's how we count it, and so on and so forth. All right. Please let me see our comment in the comment section. Do you understand up to this point we are on right now? I trust you might not get it clear all at once, but you are on point, right? You will still come back to this video if there's any question. But let me know in the comment section. Are you with me? Are you with me? Are you with me? I'm checking all responses. All right, good, fantastic, fantastic, fantastic. So the next thing I'm talking about is the lot size. After pips, let's now talk about lot size. We will still talk about how these things correlate. So don't worry. We will pick them one by one and align it together and make sense out of it. What is a lot size? All right, let's go back a little. Historically, currencies were traded in specific amounts called lots. During our forefathers' days, you would have watched. There are some Yoruba movies that speak some of those history, whereby when they want to transact, you see they will pack the cowries in sacks or bag, and they will give it to them. They will say, "Okay, womewa, okay, igba, okay," stuff like that. That's how they sound it. For those that are even that stays with this grammar or in the villages, they will still understand what I'm talking about. So you see that sack that they pack, that they give to them, or that bag in that akpo or something like that, is what they call lots. So that's how currencies were transacted then. Forex don't dey reign tey tey o, no be now o. It is just more rampant now. It is more, everyone now do it, just like real estate. Everyone now wants to buy land. Everyone, even those who never chop belle who won't buy land, secure the guinea corn and all of it. Now, this lot size, how do we now relate the traditional one to this our digital? Let's now correlate it together. I said lot size directly impacts in the risk you are taking in a trade. In trading, we have standard lots, which are hundreds units. So now we have 3 specific sizes of lots. We have the standard lot size, we have the mini lot size, and we have the micro lot size. Now take this example as the akpowo that I said, the cowries that were packed in sacks. Then if they want to give money, it is usually in sacks, in all these bags. That's what I mean. It might be small, it might be big. They will give it to themselves. They already know the amount that will be in that pack. The first is the standard. It means you are buying or selling 100 units of that currency if you use a standard lot. If you use a mini, it means you are selling or buying 10,000 units of that currency. Take it as you are selling 10,000, let's say a unit is like 1 stone. You are selling 10,000 stone. Do you get it now? You are selling what? 10,000 stone. That is what it means. And micro lots, which is what? 1,000 units. Now let's now relate this standard, mini, and micro in terms of actual figure. Now we now use pips. You remember pips is the different distance from of each prices from price A to price B, and lot size is how you it is the specific amount of this money. There's now a correlation there that we want to arrive at, and you will get it. Now for micro lots, what you will use on your MT5. Don't forget MT5 is where you place trade. It is on your MT5 that you will choose the lot size you need, that you want. On your MT5, what you will use if you want to use a micro lot is what? 0.01. And if market should now move 1 pips in your favor, 1 pips in your favor, if you use a micro lot of 0.01, you will make what? 1 cent, which is 0.1 cent. The calculation is there already on your screen in units, movement value. I don't want to go deep into that. Let's go straight to the point. If you know this calculation, it won't give you any. This is not what you will use to make money. You just want to know what does a lot size mean, and what is the figure of that lot. A pips is the distance of each price, and currency moves from price to price. Products move from price to price. The price they sell it today is not what they sell it tomorrow. If the price are fixed, there won't be money anywhere. The price needs to range. Lot size is now how we count this money. All right. Okay, let me give you an example. Remember the bill of currency that I used as an example before. Let's say they now put 200 naira notes, denomination of one bill of it, 100 naira denomination, one bill of it, 500 naira denomination, one bill of it. In every bill, the number of notes in that bill is usually the same. But so far the denomination is different. The total money in that bill will be different. Do you just understand what I'm saying? If they give you 100 naira bill now, and they give another person 200 naira bill, when you guys get to and you start counting it, or even if you know the number that will be there, the total will be different. Your 100 naira bill is 10k. Their own 200 naira bill is what? 20k. Now what differentiates it? Even though the note in it is the same, because the denomination is different, the total money also is different. Now in this instance, the number of notes in that bill is your pips. The denomination is your what? Lot size. Do you understand it now? So it means even if you and someone catch the same number of pips on a trade, if your lot size is different, the amount of money you will make will be different. How do we now know this calculation? Micro lot, which is 0.01, 1 pips there will give you what? 1 cent. So it means for you to make $1 using micro lot, you need to catch 10 pips, which is 10 times 0.1 cent, and that gives you $1. Now, if you catch 1 pips again, but you use mini lots, which is 0.1, which is like saying you are buying 10,000 units of that currency, you'll be making $1 per 1 pips. So it means for you if you catch 10 pips using my mini lot size, you'll be making $10 already. Whereas for someone using micro, for them to make $10, they need to first of all make 1 cent in 10 places equal $1. Then they will now make that $1 in 10 places to equal $10, which means they will be 10 times 10 equals 100. They need 100 pips to make $10. But for someone using mini lots, which is 0.1, that person need just what? 10 pips to make $10. Because 1 pips of mini lot is $1. Also, for someone using standard lot size, which is 1.0, meaning you are buying hundreds units, your own figure per 1 pips, you'll be making what? $10. Do you see the difference? Per 1 pips, you'll be making $10. And the calculation goes like that. So if you catch 10 standard lot size, you'll be making what? 10 times 10, that's 100 already, $100 already. Now, what determines the lot size you will use on your account is your account capital, your account size. If you have an $100 account, you can use a standard lot size. It is like saying if you have 100 naira bill, it cannot amount to 20k except you add another bill to it. And there's limit to what you can buy with it. Do you understand it? So that's just what it means. All right. That's the nearest explanation I can use to explain lot size and pips to us. If you are still confused, what you just need to do is get back to this video and watch it again. You will definitely understand it. It is very, very straightforward. Very, very straightforward. All right. The next we are going into is leverage and equity. Leverage is the ratio of traders' capital or funds to the size of brokers' fund made available for trading. In other words, leverage is borrowed funds in order to scale up investment capital for potential results. Now, remember I said the market is valued at $7 trillion yesterday. That's a very big market. Imagine in a $7 trillion, you are coming with your $100, coming with your $1,000, even if it is 10,000, even if it is $1 million. Do you think it will have impact in a $7 trillion? No. What will help you be able to trade is what? Leverage. And what gives you leverage? It is with the help of your broker that you choose. When you're opening an account, you get to choose the leverage you decide. So leverage is simply a wing that your account will use to be able to trade, to fly in the market to trade. That's the simplest meaning I can give it. Now, how do we now interpret this leverage? The one you will choose when we are opening an account. Let's say you want to open an account and you choose a leverage of 1:500 as an instance. Then you now fund $100. You fund $100. So what it means is you'll be able to trade as if you 1:500. You know ratio. One ratio means one the amount you fund, which is $100 times 500. So it means you'll be able to trade as if you have 500 times $100, which is what I think that's $5,000 if I'm not wrong. That's $5,000. So you'll be able to trade with your $100 account as if you have $5,000, but you don't have it. Remember what I said up there, the ratio of traders' capital to the size of brokers' fund made available for trading. Your own money, the trade you decide to trade. You send the broker in the market, you are not there. You now want to buy, something. You now call broker. Hello, eba mi ra ata 100 naira. The broker is pay for you. Now this is now how it works. The broker already has Pepe. So they now sell from their own Pepe to you. They now collect your money. So what helps you in case your money is not enough or whatever is the leverage they have given you when you are opening that trade. That is what you to be able to wrap up the trade you want to take. Now you might think, oh, when I have $100, I'll be able to trade as if I have 5k. Backside, because when you trade as if you have that, everything that has good side has bad side. So you want to use a leverage that is very and that is not too much. Like let's say 1:100 or one. Even in countries like USA, they don't allow their citizens to use more than 1:50, except they've increased it now. I can remember 5 years back or even more, they only allow their citizens to use 1:50 as a everything is risky. Imagine trading 5k volume in the market with your own, so it is risky. All right, that's leverage. Now, equity. Equity is the summation of your account balance plus. Imagine you have $100, you fund your account with your $100, and you now place a trade, and you are now making $20 from that trade. Equity is now the total money you will see in your MT5. The $100 plus the amount you are making, which is dollar. So your equity will be what? $120. Let's assume you are in loss also of $10 as an instance from your $100 account. Equity will be what? $90, which is 100 minus 10. So your equity is simply the summation or subtraction of your your floating profit. Floating profit means the trade that you've not closed already, the trade that is still in the market. That is what floating profit means. All right, very good. So as your profit moves increase, your equity increases, and if your losses also, as your losses increases, your equity was it reduces. So equity is simply how to quickly know. Let's say you found $100 and you don't want to lose more than $10. So it means once your equity start approaching $90, you just know, oh, let me just close this trade. So that's one of the benefit of an equity. Do you understand it? And if you have running, your equity will be the same as your balance. But once you open a trade, your equity start fluctuating. So do you get that? Fantastic. Fantastic. So now let's go on to the next, which is equity and margin. Let's talk about equity and margin right now. So I want to be sure my people are still with me and you can get what I'm saying very well. Is that correct? Are you lost or are you tired or anything? We are now going deeper. It is now looking like what are we doing? You are getting tired already. You don't need the money again. Hmm? Let me see some response for us. Are we active? Are we active? All right, good. Fantastic. Good. Good, 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 good. Hot people, hot boys. Olambo. All right, so equity and margin. That's the next topic we're going on to. Okay, okay. I'm loving this. Seed of Grace, Breed Paid, Titilayo Ayodele, Precious, Ibrahim, lots of people. That's fantastic. Now, equity and margin. That's the next topic we're talking about. What does your equity means? I've talked about equity earlier, actually. Okay, this is just a deeper explanation again. For instance, you have an open trade running in profit of $2,000 and you have an account balance of $2,000. Your profit will be what? Your profit will be $4,000. And also, if you have an account if your account is running $2,000, so your equity will be what? Your account size. Let's say you have a 10K. Let's say you have a $10,000 balance, but you have a running loss of 2,000. So your equity will be what? $8,000. So whatever you are making, profit or loss, is what will determine your equity. Do you understand? All right. So the next thing I'm talking about now is margin. Margin. This one is quite tricky, but pay attention. Yeah, a bit complicated. Yeah, you can't understand it at once right now. You need to come back to this video and watch it again and again and again and again. That's it. So there are some of these things I'm saying now that you didn't hear yesterday. You didn't hear a day before yesterday. So they are new to you. So it is normal to get confused. All right. Just make sure you come back, watch it again, understand it. The same day you entered your uni or your school, you didn't understand everything the lecturer or the teacher was saying. But as you keep reading, and going to classes again, we understood gradually. All right, what is margin? Margin is calculated based on leverage. Now, this is what it means. Remember the scenario of the ATA that I used, where someone is in the market and you call them to buy pepper for you. Margin is now, let's say before this person now go, let's not even say, before this person go, you've already given them $1,000. $1,000. That when you get to this market, take the more like a deposit. Now, whatever amount it is in the market, put this as a deposit to buy it. So I will, let's say the quantity of the pepper, the price of the pepper is 10K. But now because $10,000, but now you have 1K. You now put that 1K down. That okay, Egba one pepper, I'll be paying you. That's the real life one. In this market now, it is something alike. So it means the price, the currency you're selling, the amount it is being sold, that will be your margin, depending on the lot size you choose and the leverage you are using. What does that mean? If you are buying right? I've said it earlier that if you are buying $1,000, which is around 1,450, if you are buying one, they might sell it for you 1,500, even though it is 1,450. Because but if you are buying up to, let's say, $100, they can reduce it to 1,450 or even 1,460. They will reduce it. So you see that 1,460 times whatever quantity of dollar you want to buy, that is your margin. Are you with me? That is your margin. So it means for someone that wants in naira now, their margin will be what? 1,450. But if you are buying, let's say, $10, your margin will be what? 14,500 naira. So margin is more like the amount selling that thing you want to buy or sell, that it will now be kept aside. This is now where it is being used. Your broker will now keep it aside in your capital. Let's say you want to buy, you that want to buy something of 1,400, you have like, let's say, 5k or 2k or thereabout. You see that 1,450, they will now deduct it from your balance and keep it aside, as this is like a collateral. Like, this is the amount you kept aside for this commodity that you want to buy or sell. Do you get it? That they want to buy or sell. So after the trade, it will be reversed to you. And let's now say you are in loss. Once your loss start approaching your margin, that is where you see traders say, oh, they receive margin call, or they say they have been liquidated. That means your account is ready to be blown. Do you get it? It is ready to be blown. So margin is simply the amount that the commodity you want to buy or sell is exactly being sold. And that's the amount you just put aside out of your capital. Do you understand it? I'm sure you don't understand, but you need to come back to this video. Trust me, you need to come back to this video. You need to come back to this video. So let me use another way to explain margin. Think of margin as a security deposit. Okay, let me use another. I just remember this. You will even want to laugh. Now, for those of us that, I think we are still Gen Z now. You were born in a very, very, not 2005 or 2007 kids. You know if you want to go and buy mineral, there's only go. All this Coke or Fanta, the bottle is usually very thick. Then let's say you want to go and buy one. I can't remember how much they were selling in there. But one will now give us an amount that exceeds the actual amount they are selling it. Because you want to bring the go home. Let's say they didn't have a good. You want to bring the go home, come home. So they will now give you that amount, that when you reach there, give them that amount until you now bring back the ego. They will not give you your balance. You see that amount that you keep them for the ego, so that you can take it, and when you bring your ego back, you collect it back. That's the margin. That's your security deposit. Say, even if I don't now bring back this ego, then you have something. Can you relate? If you can relate, let me know in the comment section. Can you relate to what I just narrate? Can you relate to that? Let me know. Let me see those that are ready to be married or married already. Safe. If you can relate, you must have at least 17 at least minimum. We can relate, yeah. If you can relate, go and marry. Go and marry right now. Precious, go and marry. Titi Layo, go and marry. Ahmed, go and, you must have at least 17 kids right now. At least minimum. Because Tinubu is ruling. All right, so that's simply what margin is. Should you hear me? Very good, very good, very good. Yeah, seed of grace can also relate. Go and marry. I want to see your wife tomorrow. Or is it if it is a lady, I want to see your husband. So the next we are talking about now is take profit and stop loss. You see that we are getting deeper, and we are gradually approaching an alt. This is about 8:52. We are almost 40 minutes into this class. All right. Okay, someone said they are still doing it now. Oh, it's been a while. Now we have plastic bottles and all of it. But there are some people that still, so it's possible. All right. Now, what is take profit? What is stop loss? Imagine a scenario whereby you place a trade, your phone off, or a trade, your screen spoil, You can't click. You can't click anything to control the trade again. And you've already clicked buy and your money is on the line. And remember this thing, we don't know where it will go. You just trade. How will you feel? They now create something to control the risk for us. That's where take profit and stop loss comes in. Take profit, read it after me. Take profit. It means take your profit. Stop loss, stop your loss. So there is now something that when you want to place trade, before you click that your buy or sell on MT5, you can now input a price that, hello broker, when my profit has reached this amount, then I am cool with it. Close this trade for me, even if I'm not there. That is what we call take profit. And stop loss means, hello broker, if I have loss up to this amount, this is the amount of loss I can stomach. Close this trade for me. I can't stomach more than this loss. So it simply means stop loss is the security of your account to save you from blowing it. And that's to tell you that you must always, let me don't forget what I'm saying now. Always, don't you ever click buy or sell. You see, that one is like a trait. Don't you ever, you must safeguard your account. You must not blow account. Don't you ever click buy or sell without inputting stop loss. Don't do it. There's no pride in it. Don't be what is stop loss? There was a meme one time that I saw. The guy was trading and was making money and he doesn't even know what stop loss is. Now you know. Don't repeat the same. So set stop loss on your account. It is to reduce or to control your risk. Let's say you have an amount of $100 in your account and you don't want to risk more than $10. So stop loss is how you will calculate it. It is what will help you to control the risk down to $10. Now, how do you now know these risks will not pass $10? You should know already. If you remember pips and lot size, you will know how much will be equivalent to $10 in that your amount. Let's now do a quick one. Let's say you are trading Euro USD. Let's say you are trading Euro USD and you have what, 10 pips as your stop loss. 10 pips as your stop loss. If you are using mini lot size, what lots? Okay, you are using mini lot size. And how can I put it? Okay, let's say you are using mini lot size and you want to okay. It is the trade itself that will tell you the lot size to use. You have 10 pips stop loss and you don't want to risk more than $10. How will you know the right lot size to use? What will you do? Let me not stress us. Let me not delay us. So what you simply do is $10 using a mini lot size. That's 0.1. All right. Using a mini lot size, that's 0.1. And we said 1 pips in 0.1 lot size is what? $1. So it means for you to be equivalent to $10, you need 10 pips SL. And 0.1 with a 10 pips SL will be equivalent to what? $10. So now you know the right lot size to use when you want to open that trade. So it means if you have 10 pips SL and you open the trade with 0.1, if the trade should hit your SL, you won't lose more than what? More than $10. And you have $90 remaining to yourself. So stop loss is to control your risks in the market. It is the secret. It is what will give your account long life. You don't want to click buy or sell without setting it. And take profit on the other hand is that one is, that's to say, let's say your plan is to make $50 per day. You will just do the same calculation as the one we did while you want to get your stop loss. And when your price reach there, the broker can close the trade for you automatically. Even if your phone switch off, they will close it. And if you are there, you can do it manually. You can simply just close your trade when you see that price has reached your take profit. How do you know where to take profit? How do you know where to set your SL? Structurally, when we get to market structure, when we use our trading view, you will understand all these concepts and you will know how to do it. Might not be tomorrow because tomorrow is just, you know, very few hour, but we will try to go as deep as we can, and then we'll put everything to the next phases that we'll be announcing tomorrow. All right. Oh, sorry. Some one of us has network issue. Sorry about that. Sorry about that. Next, I'll be talking about right now is other types. Other types. Now, remember we said you only do two things. You either click, you either buy or you sell. But there are ways you place order. What do we call order? That your buy is order. That your sell is order. There are two ways you can place order. We have the market execution or instant execution. It is called market execution or instant execution. That means you are not waiting for price to get to anywhere. You want to get now students are resuming to school. You want to get let's say you want to get a phone and the phone is valued at $1,000 as an instance. But they've not tell you that okay, during this period, this phone price will reduce. You now tell them, no, I'm not waiting for it to reduce. I want to buy it at this price, $1,000. That's what I want to buy it at. That means you want to buy it at what? Market execution, instant execution. You are not waiting for price to get to any price, any new price again, to go lower or to go higher. You want to buy instantly. That's what market execution means. When you now wait for price to either go up or come down, that is what? Pending orders. Pending order. So this is you telling your broker. And how do you do this? These are one of the ways the broker help you also. They work for you. And that's the essence of the money. We are paying them. We are paying brokers, actually. Can you imagine? So we have four ways we can carry out spending orders, which we'll be explaining in the next slide. Also, please don't abuse the use of pending order. If you've done your analysis and you know that okay, once price gets to this amount, it will start buying. So you now set your pending order at that price. If price should move against you, you will lose money. So you want to make sure you are very good with your analysis before you start implementing this pending orders. Do you get that? So the first one we'll be talking about is buy stop and sell stop. Buy stop. Remember we said there are four, so they are split into two: buy stop and sell stop. That's two. Then the next two we will talk about in the next slide. Buy stop and sell stop. Now read after me. This is an order set to instruct the broker to activate a trade at certain price level, which is above the current market price in a bullish direction. You might want to ask me, what is bullish? It is in the last slide. We'll go reach there. Calm down. Let me give you a hint. A bullish market is a buying market, a market that we are supposed to buy, a market that is buying, a market that there is more buyer in that market is a bullish market. Should you hear me now? Very good. So buy stop is now that order that you tell that, okay, this market is already going up, but I don't want to buy at this price. I want it to go higher before I buy. Probably, maybe it is to give you more confidence in that trade, or you just decide that that's what I want to buy. What do we mean? Price is moving from, let's say, 1,000 to 1,001 to 1,002. But you know that means it's buying. For anything to go up, it means people are buying it. For anything to come down, it means people are selling it. You understand? It means people are selling it. So price has moved from 1,000 to 1,000. You don't want to buy at 1,002. All right. You now want to wait for price to get to 1,400 before you buy. That means what you will set at 1,400 is what? Top. 1,400 is above 1,002 that the price is currently, but price is already moving up. That's the difference. Look at the arrow. Look at the arrow of this example. Price is already moving what? It is already moving up. So you now set it also in a buying trend already. Sell stop is just the difference. It means the price is already bearish. It is selling. You now set your stop. You now set your sell stop below the current price. Let's say price is selling from 1,000 to 900 to 800, but you don't want to sell at 800. You want it to get to 700 or 750 before you sell. So the pending order you will set in that kind of instance is what? Sell stop. Do you get it? Sell stop, buy stop, sell stop. Market is already buying. You don't want to buy. Buy stop. Market is already selling. You now want to sell. Sell stop. Now what is the remaining two? Let's go right into it. So the next two is buy limit and sell limit. Buy limit and sell limit. Don't forget. Now, what is this? What does this one means? Read after me. This is an instruction to the broker to activate a buy trade for a selling market. Do you see the difference? The first one, which is buy stop, is buy trade in a buying market. But this one, a buy trade in a selling market. It means, let's say the price is dumping from 1,000 to 800 to 900 to 700 to 600. But you know that once it touches 500, it will start going back up. Then after, how do you know all these things? It's true analysis. Oh, it's true analysis. So you might be wondering, how will I know where to buy? Will I know? You will understand it, especially tomorrow. They will understand it a little bit and be able to practice it. Don't worry. All right. So when you expect, you've done your analysis, and you know that once it gets to 500, it will start going back up. The kind of pending order you set in that situation is what? Buy limit. Price is already was initially coming down. Look at this arrow. It was coming down. Then it's got to a point, it start going back up. That point that it will turn is where you will set your buy limit. You will know. Don't worry. The knowledge is very beautiful. When you know it, you now see that, oh, this thing is as beautiful as this. It is not even as hard as they make it seems. That's it. You say the same. Don't 90 days before next year, if you are with me all through, trust me, you understand all this stuff. And the other one is limit, which is the opposite of buy limit. It means the price was initially buying, it is going up, but you now know that once it touches this price, it will start selling. Imagine when Apple was about to release iPhone 17. You know, the previous phones, they were bullish. It means they were buying, the price was increasing somehow. But immediately they increased the app 17 Pro, their own those ones price started dropping. So maybe you now you want to buy. In that instance, you want them to sell to you, but you don't want to buy at the price that they have it there. So you want it to get to wait till when Apple will now release their phone. Let's not say when Apple will release their phone, it means the price has reached a new high. Then that's where you now sell. Do you understand it? So let me use a figurative example so you will understand it. Price is moving from 600 to 700 to 800 to 900, but you've not done your analysis. You know that once it gets to 1,000, it will start dropping. So you just set your sell limit at 1,000. So once price there, your trade will be activated by your broker. You set stop loss and TP also. If your TP should hit, you make money. And if you are not from me and you market did not know you and market slap your SL, you lose money. So stay calm with me and make sure you understand fully before you click any buy or any sell. And this is the last slide to end tonight's session. All right. This is the last slide to end tonight's session. So let's go around it. This is just a quick recap of everything. So we have the bull, which we call the buyers. The bull are called the buyers. The bears are called they say, oh, the bulls are in control. It means they are the buyers. Now, how do we get the name the bulls for them? Have you noticed all these movies? I was small on documentary, Naji Wide, all of these things, whereby there are some bulls that will be fighting, that will be attacking people. Have you noticed that if a bull wants to fight, it will just pick whoever it is facing, maybe a human or any animal or even and it will throw them up in the sky. That's what the buyers does. When buyers are many in the market, they will keep pumping the price up. Do you understand it? They will keep pumping the price up. But if a bear wants to fight its prey, it will just keep eating them down to the ground. And that's where they get the name for the sellers. Because when sellers are in the market, they want to make sure the price keep tanking, the price keep dropping. So that is the meaning of those two words. The bulls are the buyers in the market, the bears are what? The sellers. Then we have long. When a trader tells you, oh, go and long BTC, go and long Euro USD, go and long USD JPY, it means buy it. If they say short, it means what? Sell it. Sell it, buy it. So if they tell you, oh, the big banks are longing this pair right now, you just know that they are buying it. Do you get it? Now, Remember, I said bulls are the buyers. So the market the buyers are in control of is called a bullish market, a buying market, which is also called what? An uptrend. Uptrend. Don't forget, uptrend. That's a bullish market. A market the buyers are in control of. A market going up is called a buying market, and it is an uptrend, which is called a bullish market. And a bearish market is just the opposite of a bullish market. A bearish market is a selling market, which is called a downtrend, which means what? A market the sellers, the bears, are in control of. Do you understand that? While a trending market is what? A market with an obvious direction, a market that knows where it is going. And now, if I can ask you that, what is the direction of the market? It either goes up, which is an uptrend, or it comes down, which is a downtrend. You know that already. Hmm. Very good. Thank you for paying attention. So a trending market is a market with an obvious direction, just two direction. It either goes up or down. If it is not going up and it is not coming down, then it means what? It is a ranging market. That's a market with no direction. Do you understand to that point? If you're with me up to this point, let me see your answer. Let me see your answer. What should we comment? Say I'm here, I'm here, I'm here. Active, active. Comment active. Let me see. That means you are on your path to profitability on this journey with me. And we are doing it together. Trust me, we are doing it together. We're doing it together. We've done it to a lot of people. A lot is your turn. And we are rewriting the history. If you've been making money before, it is about time to make more. If you've not, it's about time to increase it. Active. Okay, I can see my people. Active, active. Fantastic, fantastic, fantastic. Okay, my people are active, active. It shows we are paying attention. We're paying attention. Trust me, let me tell you today, it won't be easy. If you want to give up, you can sleep now. But is it worth it? Yes. So if it is worth it, if you need to sacrifice 3 months, 6 months, 1 year of whatever you own to earn something that will pay you forever, I think it is a good business. Look at what we are sacrificing and stressing and hurting ourselves for in various institutions that we are in. Yeah, we don't even, that doesn't even have an assurance for any future for us. Yet we are struggling for it. So if they now, I don't know what you've heard about Forex before. I mean, I'm here to tell you, you will put in the work. You won't just sleep and wake up and become a millionaire and become a billionaire. You and buy Lambo. You will put in the work. So you be ready to put in the work. I'm just hinting you now. I hate people that are not active. You want the life, but you can't put in the work. It is not possible. Go and meet that baba in Abule. Na them fit do that one. But if you need a very good means here, you don't want to do any biza nonsense. You want to do biza forex, you put in the work. So are you ready to put in the work? Be very active. So now is the time to ask a question. So you should ask your question. Let's attend to question. Oh, someone sent a question and retracted the message. Oh, limit reversing. What does that mean? So send your question in. If you have any question so far, send it in. Send your question in. I know there will be many questions. Any question? Okay, someone said stop loss. I don't know what that means. Please try to pull more details into your center. I understand what it means. So what are you confused about? Let's talk about it. All right, what are the questions? Or probably you can send it on WhatsApp. Okay, good. Still, I daily send a question. Why do people use buy limit or sell limit since the market is going to keep trending in that direction instead of just using instant execution? You are in this market. You can have different buyers. Sometimes it is to have more confidence in that trade. So when you see that, okay, you've done your analysis, you know that if this price should cross this amount, this price, then it means it will be going up, 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 up. So instead of you to now buy at that price, whereby you won't have peace of mind, you wait for it to cross that, then you now buy or you now sell. So do you understand it? So it is just to earn more confidence and to grab more uh, criteria of that trade, if it will play out or not. So those are the reasons. All right. Is there any other question from anyone? Also, we've done various videos about these beginners or basic topics. So you can always go to them, look at other videos on our YouTube, short videos. If this one is too long for you, just watch them and understand it. And if you also can just sacrifice some minutes, hours to relearn, to understand better, you should come back to this video and watch it again and again till you understand it better. So if there's no more question, we will call it a night right now. People are active. We'll call it a night right now if there's no more question. So are the questions done? Are we through with the questions? Is there any other question? Is it question or question? Question or question? Oh, you're welcome. You're welcome, fam. You're welcome. You're welcome. So after tonight's class, I'll be sending in tonight's assignment to the group. Make sure you submit 10 a.m. tomorrow. All right. Those of you that you are copying, I can see you. I will come and steal your tongue one day. Keep calm. Keep calm. Keep calm. All right. I can see you all appreciation. Thank you for thanking me. Thank you all so much. I appreciate you. I appreciate you. I appreciate you too. I appreciate you too. I love you too. I love you too so much, brother. My namesake. I love you too. I love you too. Let's put in the work. So good night, everyone. God bless up. Don't forget, only way is up.